In 22 years of trading, I've watched dozens of clean-looking backtests blow up the moment they go live. The win rate stays the same on paper and collapses in execution. Most traders blame the model. They're wrong. The model is usually fine. The testing is broken. In the next 12 minutes, I'll walk you through the 3 reasons AI trading backtests fail in live markets, in the order they actually bite. The third one is the most expensive, and almost nobody talks about it. Let me set up the frame first. You build a system on years of historical data. You see a clean equity curve, manageable drawdowns, a win rate that looks meaningful. You deploy real capital. Within the first few months, the equity curve looks nothing like the backtest. Most traders respond by rebuilding the model. That is almost always the wrong diagnosis. The model is not the problem. The testing environment is. The backtest was built on assumptions about data, about market structure, about how orders get filled that do not hold in real markets. And there are 3 specific places where those assumptions break. They break in the same places, in the same order, in almost every system I have reviewed. Reason 1 is data quality and survivorship bias. When you pull historical price data for a backtest, you are almost always working with cleaned data. The provider has already stripped bad ticks, filled gaps, and adjusted for corporate actions. That is fine for research. It is a liability for live deployment. Bad ticks arrive in live feeds. A fill price that your backtest pipeline would have flagged as a data error is real money in a live account. The model was never trained to handle it because the training data was pre-sanitized. The deeper problem is survivorship bias. If your model was trained on a universe of stocks, ask yourself, does your historical dataset include companies that were delisted, went bankrupt, or were acquired during the training period? Most data providers do not include delisted symbols by default. They give you the universe of companies that survived. Your model has only learned from winners. It has never encountered what a distressed company looks like in the data, the volume anomalies, the spread deterioration, the gap patterns, because those companies were removed from the dataset before you ever saw it. When your model runs live, it will encounter these instruments. It will apply winner-based logic to situations that were structurally excluded from its training. The results are rarely good. The fix is point-in-time data that includes delisted and merged symbols. This is harder to source. The backtest runs slower. It is also the difference between a model that works on paper and a model that survives contact with real markets. Reason 2 is regime change. Your model was trained on a specific slice of market history. It learned relationships that held during that period. When the environment changes, and it always changes, those relationships may not transfer. What has shifted in modern markets is both the speed of regime transitions and the degree to which AI systems extrapolate confidently into conditions they have never seen. The model does not know what it does not know. It produces the same signal quality estimate across every market environment because it was never shown the conditions where it is wrong. The most common version of this problem is volatility regime mismatch. A model trained on a low volatility environment will systematically underestimate risk when volatility expands. It holds positions sized for calm markets in a storm. The drawdowns that result are not in the backtest, not because the model is wrong about direction, but because the sizing assumptions were calibrated to a different world. Before we continue to the third and most expensive reason, if this kind of systems-level breakdown is what you want, hit subscribe. 1 of these per week, no market noise. The practical remedy for regime sensitivity is volatility-banded gating. You segment market history into regimes based on a rolling measure of realized volatility: low, elevated, high. You train a model for each band. At runtime, you identify the current regime and route to the model trained on conditions that match it. When regimes transition, models transition. If you are currently running a single model across all market environments, you are accepting a category of risk that will not appear in your historical backtest statistics. The risk is real. It is just hidden. Reason 3 is execution slippage. This is the most expensive failure mode. Almost nobody models it correctly. In a backtest, fills happen at the price your model observed when the signal fired. The assumption is that the fill is immediate and frictionless. That assumption does not exist in live markets. In live trading, your order hits the order book. A market order moves through the spread. If the spread is wide, which it will be precisely when your AI system is most confident, during high momentum and high volatility conditions, you give up value before the trade is started. A limit order avoids the spread at the cost of potential non-fill. The backtest has never modeled this trade-off. AI systems compound this problem because they generate signals during the same conditions that degrade fill quality: news-driven moves, volatility spikes, thin overnight sessions. The model is most active when the market is hardest to trade. The backtest has never seen this relationship. For multi-leg option strategies, spreads, condors, ratio positions, the gap between mid-price and actual fill is often larger than it appears. A strategy filled at mid-price in a backtest has never actually existed in real markets. It is a fiction the backtest accepts as fact. The solution is fill simulation. Build or source a model of expected fill quality by asset class, strategy type, volatility regime, and time of day. Apply it to every backtest run. Your simulated equity curve will look worse than the clean version. That is the accurate version. Size positions and set performance expectations against the accurate curve. Each of these three problems has a known remedy. For data quality, use point-in-time data that includes delisted instruments. Apply the same cleaning pipeline to your live feed that you applied to training data. Forward, not retroactively. For regime change, build a regime flag into the model architecture. When current market conditions fall outside the training distribution, the model reduces exposure or steps aside. A model that knows when to stop trading is safer than one that does not. For slippage, build a fill simulator. Apply it consistently. Do not present a mid-price backtest result as a production performance estimate. The framework that ties all three together is walk-forward validation. A walk-forward test trains the model on one segment, tests it on the next unseen segment, then expands the training window and repeats. The output is a sequence of out-of-sample returns that mirrors how the model would have performed in actual deployment. If the walk-forward curve degrades sharply against the in-sample curve, the model is overfit. If it holds reasonable shape, not identical but directionally consistent with manageable decay, the model has cleared the first real bar. Layer a paper trade observation period on top of walk-forward results before committing capital. Run the model live, observe actual fills and signal quality, and confirm that the live behavior matches the out-of-sample expectation. That process is the closest thing to a reliable pre-flight check that exists for algorithmic systems. None of this eliminates risk. All of it reduces the probability that your backtest lies to you. Reply in the comments. Which of the three has hit your live account hardest? I read every reply on Sunday long forms. Educational only, not financial advice. Past performance does not guarantee future results. Consult a licensed advisor before trading.